Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off. I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
Can you hear me now? Hello, everybody. Sorry about that little audio difficulty. Can you hear me now?
Yes.
All right. Hey, welcome, everybody. Happy Friday to you. My name is Brett Swarts, and we are here with another Capital Gains Tax Solutions Deferred Sales Trust kind of masterclass mastermind. We really believe that most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, and not having a clear plan is the enemy. And using a proven tax deferral strategy such as the Deferred Sales Trust is an amazing way for you to exit highly appreciated assets, including primary homes, businesses, real estate, cryptocurrency, so you can defer millions of tax, and so you can create and preserve more wealth, or help your clients, friends, and family do the same. And for those again who don't know me, my name is Brett Swarts, and I have a passion and a skill set to help people and to train people on how to do this. And it started out not knowing anything. In fact, I didn't know much at all, except had some real estate knowledge and was doing some 1031 exchanges with some clients at Marcus & Millichap, and quickly found out that the 1031 exchange is not always our friend. And the 2008 crash hit, and I went from making a little bit of money to like nothing overnight. And I saw a lot of clients, friends, and family lose half or all of their wealth. The biggest reason is because they didn't have what we like to call a strategy to give them optimal timing, diversification, and the ability to eliminate the need for the 1031 exchange altogether. And that's when we discovered what we think is the best secret in the exit planning world, which is the Deferred Sales Trust. And so now we just help people use this every single day. We're constantly working with people to plan or execute or close on deals. And so we are focused like a laser, and we're happy to kind of share our secrets with you so you can help yourself or help your clients in the future. That being said, I am joined by some amazing people that work alongside that are strategic alliances. some are on the team, and we're going to kind of collaborate. We typically talk about not only the vision for what this mastermind's about, but then number two, we actually go into live deals that we're working on right now, or deals that are closing. So you can kind of get a hands-on feel for how the Deferred Sales Trust works and what's actually possible with it. And then from there, we open up for questions, and you can talk about a live deal that you have going on, or just some common questions that people have. That being said, Pierce York is in the house. He's part of the co-host with me and all of the podcasts. Pierce, how are we doing today?
Doing phenomenal. How are you?
Doing fantastic, my friend. And Pierce is a luxury real estate agent down in Newport Beach. Also does some commercial brokerage down there as well. And he's becoming an expert in the Deferred Sales Trust as well. Doing great. Do we have the Jake Miller in the house? I'm not sure if I'm seeing his amazing hair. I wore the Mazalon sweater for us today, but it looks like he might be out. That's okay. No problem. Jake is probably traveling the world in some amazing place. He's a CFP financial advisor. We call him the CPA Whisper. He's typically here, but he's not here this week, but that's okay. Maybe he's coming a little bit late. But that being said, me and Pierce are going to go ahead, Pierce.
I said, I think he's in Colombia.
Good for him. Good for him. Hopefully he's finding some good Colombian coffee and maybe a cigar or two. But be careful with all that. That being said, Mr. Pierce, talk to me about, my daughter's coming in to say hi. Talk to me about your last few deals that you've been working on, Pierce, what you're seeing out there right now. And also a little bit about the vision for the mastermind.
Cool. So I'll start with the vision, if that's cool. So the vision for this mastermind is to create a place where people can come and learn about the different tax strategies to help them create, preserve, and grow their wealth. Enhance their investment portfolios, and just have a place where they can bring their CPAs, their financial advisors, estate planners, tax attorneys, all those people that are involved, get them to know us a little bit, get them to ask questions, get them to know, like, and trust, as well as, kind of figure out some good potential strategies for them, and to be honest, it might not be the Deferred Sales Trust. It might be a different strategy, which we've gone through, on this podcast, our mastermind group, plenty of times actually. So, and that'll kind of bring me to one of the deals I'm working on right now. I have a condo. This guy bought the condo in 1985 for $140,000. We're trying to sell it. I'm hoping it closes for around $520,000. And he's going to have a pretty significant capital gains tax. He had it as a primary residence for he's coming up on his 5 years right now of not living in the home. So 2 of the last 5 years, he had to have lived in it and owned it, and he hasn't lived in it for 2 of the last 5 years. We passed December, and so he really wants that 121 exclusion because that's going to increase his basis from 140 to 390, which will substantially reduce his tax liability. But even if he doesn't, he doesn't really know if he wants to do a deferred sales trust because he's not at that $1 million net proceeds, $1 million gain. So that's kind of like the minimum that we say that's an absolute home run. So you kind of have to be a $1 million net proceeds, $1 million gain.
It's good, Pierce. It's good. It's good. So perfect. Thank you for sharing all that. It's really helpful to understand that you want to make sure you have a big enough deal. Because if it's too small, then it doesn't make sense with our fees. So it's got to be a good ROI. In fact, we actually have someone on today as well who was looking at this for himself. His name is Mr. Alexander, and he's a really smart, sophisticated entrepreneurial person for many years in Silicon Valley, and still is. And in fact, he was actually looking at it for his own property, but ended up not using it because he had some carry forward loss. So maybe Mr. Alexander would like to come on and share that part of the story if you want to share, Tom. What do you think? you're still there, you're on mute. I think you have to unmute yourself and then we can hear you.
Okay. So I had a property in Atherton, California, and I was planning to sell that and use deferred sales strategy. And I talked to Brett for a while and we looked at various angles, and I found out very attractive to do that. But then I also found out that over the last 20 or 30 years, I have carried over a lot of tax losses. So I had enough of that. So by the time I can use the capital gains tax, whatever left behind was less than $1 million. So Brett suggested it may not be the right vehicle. And so I really admired that he was open and coming and telling me, hey, let's not do this because it may not be worth it. So, but I fell in love with it, and I have a lot of my friends who are in similar situations, and so I joined Brett's group, and I'm an evangelist for this effort.
And
so
we so appreciate it. Yeah, Tom's come on he's come actually on the team here. Full disclosure, and he's actually going to be helping people who are looking at this for the first time determine if it's a good fit for them or not. And ultimately, that's what we want. Like, we want it to be a win-win for everybody. So it's got to make sense financially. It's also got to make sense for your goals, right? And so the first step is really to clarify your goals. One of Tom's goals was to sell and defer his tax. But as we unpacked it with his CPA, we found out that he had the loss, and that loss, carry forward loss, was able to offset in the same year the sale of his house in Atherton. And so it basically, took care of the capital gains tax. It was his loss was a solution for his gain in this new year. And that was able to diminish what he needed to pay in tax. Therefore, he didn't need the deferred sales trust and have to go through it. And so, yes, so we'll welcome him, Tom. In fact, if you're listening to this, you might actually talk to Tom at one point, because he's starting to take some of our inbound calls to work with people who are deciding to use or not to use the deferred sales trust. But Tom, a little bit more about what you liked about it. You said you fell in love with it. Talk to us. What is about the deferred sales trust that you find so attractive?
Well, first of all, I ran it through the usual way with my tax accountant, CPAs, and they did a lot of research into it. And they came to the conclusion it's the real stuff. And the most importantly, there's a law firm or a tax attorneys who will come, and I will have to pay 1% of the asset I'm going to put it into the trust. What they will do is, in return for that, they will give me a tax opinion. So even if IRS in the 1% probability they disallow it, at least I will not be penalized because I got a tax attorney sale. And then on top of it, the tax attorney said, for the future, for as long as I have this in the trust, which is about 10 years, if any audit or anything comes, they will come and defend me, and I don't have to pay them anything other than the 1% fee I pay. So that was a very, very attractive thing for me. So it took away all my guesswork and the risk and all that stuff. And so that's why I became a believer in it. And then I went and attended some conferences with Brett, and I saw the other people who have taken advantage, and I talked to them over a cocktail or a coffee or whatever, and got a lot of their experiences. And so that's how I became a complete believer in this. And now I recommend it to a lot of my friends.
That's amazing, Tom. I so appreciate you sharing that. And that is part of what our goal is. Full disclosure, we want you to become a believer in the deferred sales trust and what it can do for you and your clients. And it is not it's not an easy thing. No, it is easy if you have enough time and energy to spend with us. It becomes more digestible as you understand that it's just a promissory note. You're lending it to a third-party trust in exchange for that trust to pay you back over time. But on top of that, it's not just the structure and the strategy or the track record, it's the group of professionals to execute the business plan. And that's where we work with the law firm that Tom was referring to, that provides lifetime audit defense, state or federal, and has a perfect track record over 25 years, thousands of closes. And what's beautiful about it is, should you be audited, state or federal, they'll defend at no additional charge as part of their one-time fee up front. And they also work on a conditional engagement, meaning your particular deal that's happening, we will all look at it together, dissect it. I like to say, take an MRI of what the deal is, the contracts, the terms, the buyer, everything, review it all, and then have the option for the deferred sales trust to be in there. And should the deal not close, or for some reason you decide not to use the trust, there's no charge. And so we truly believe that takes the pressure off the whole situation, where you really get to spend some time with us and get to know us, get to know the structure, and have your professionals, like Tom said, come in and vet us as well and ask the questions, so that you can make a clear, deliberate decision about whether or not you want to use the structure and put your trust and faith in what it is and the team that's going to execute it, or whether or not you want to just, pay the tax. And sometimes it's both, right? We have people right now that, if they look at it, and some people get, they'll just pay the tax. And then other people who I would say 9 out of 10, they're going to defer the tax if it's large enough. But sometimes it's because the time consequence, right? It's squeezed. Like you only have like a couple weeks to close, and you're selling a, 10, 20, $30 million deal. And all of a sudden that pressure of time to make a big decision on something you haven't learned before, or it's new, can be really intense. And so this is part of why we like to spend every single Friday at 10 a.m. Pacific Standard Time, 1 p.m. Eastern, with you and with one another, so that we can make it not as intense, meaning you get to know, like, and trust us over time as we share these deals, as we answer questions for folks, and as we just clarify how simple really this is. And so that being said, Tom, I want you to put it in your words, right? How does the deferred sales trust work? I think it's good for people to hear it from different perspectives. Imagine you were to sell your house. What was going to happen if you were to use the deferred sales trust? What was that going to look like for you, Tom?
Yeah, the most important thing is, as soon as you get your sale agreement, or if your real estate agent comes and tells you, okay, I have a buyer who is willing to buy and sign this document, and that's the time we need to call Brett and talk to him about it. Because what will happen is we will form an irrevocable trust, where you have somebody like a Brett, or at least somebody who's not related to you, who have no vested interest in you, will become trustee of this trust. And we actually will have to move the title of the property into this trust before the transaction takes place. This is very, very important. So that's why I started looking at it almost a year. Even before I put my house on sale, I was talking to Brett, So that portion is very, very important. You need to get that in before the stuff. So
and let me clarify that a little bit too. So that is true, but there's a common misconception, which means, do I need to set it up prior to, or sell it prior to the buyer showing up? Or do I transfer my control, my ownership prior to the buyer showing up? The answer is no. We actually do it at close of escrow, although we do put option language in the purchase and sale agreement, or an addendum, which then allows an option for someone like Tom who's selling, or anyone who's selling an asset, to transfer the rights and the interest basically at the close of escrow. It's like a simultaneous close. And so again, this takes the pressure off, because some people go, well, so you're saying I have to transfer my house to this trust, and then the buyer may or may not show up, and maybe Brett wants to move in as a trustee with his family or whatever. No. We don't take any ownership of anything until basically the close of escrow and the buyer is ready to perform. However, it's very important that if the buyer has removed all contingencies and we hadn't set up the option for the trust to be a part of this transaction, constructive receipt is taken. And that is where the tax is triggered. And so that's why it's important to do everything in the right order. So Tom, keep going though. So then it closes, yeah. Tom, what happens? Like what would you have received? And if anything in the beginning, and what do you become the owner of after close?
Yeah, after closing, basically the money which the buyer provides goes into this irrevocable trust. And I do not have any control over that funds, because it is in a trust and the trustee has a thing. But I have freedom to tell my trustee if I want to buy another property, not for primary residence, for rental or investment or any other thing we can do, then the trustee will do that. So that was also very attractive for me, because then I don't own this asset because it's owned by the irrevocable trust. And if I want to invest in a real estate syndicated, apartment complex deal, or I can ask the trust to do that. And the trustee, as a matter of fact, will look into it and probably will tell me, hey, do you really want to do that? There is some risk here. Then we will work with the trust attorneys and see how we can mitigate that
Yeah.
risk.
So let me unpack that a little bit, right? So it takes dual approval for investments, right? So Tom might have a good idea or good investment, a good opportunity. As a trustee, part of my fiduciary duty is to review the investments and review the overall ability for the trust to pay back Tom, because Tom has lent the money to the trust. And so he definitely gives up some control. It's not complete control. He has what's called indirect control because he's a lender that has to approve of the investments, but he definitely doesn't have what's called unilateral control, where he can just make decisions unilaterally. It takes me as a trustee making the decision with his approval. Okay. So it's just kind of this checks and balances piece. And then part of the tax attorneys, we want to make sure that we're not stepping on over any other boundaries for constructive receipts. So we're constantly looking at that and making sure we're following all the rules. So what does that look like in practicality? So Tom says, you know what, Brett, I just sold a property in Palo Alto, Atherton. It's in the trust. And I found an apartment complex in Nevada for, let's just say it's $1 million to keep it simple. He can form an LLC in which he's the owner of that LLC, and he could partner with the trust, and the trust can come in as a silent partner, and they can go buy real estate because the trust has the ability to diversify in different investments. It could be stocks, bonds, mutual funds. It can also be in real estate or other business ventures. It can also be used for startup capital for a new tech company or something else like that. It can also go into some cryptocurrency. It's very flexible there. And Tom could say, I found this great. I think it's a good deal. What do you think? And part of my role would be to kind of vet what's going on with that investment, that opportunity, and then collectively, yes, it can go into that. Now, someone might say, well, I'd like to have unilateral control. Okay, well, then you could try for a 1031 exchange, right? Where you can make your decisions there. But the challenge with that is you're going to lose the ability to sell high and buy low typically, right? Because you're having to sell high and then buy typically higher 180 days later, especially right now with interest rates that have nearly, let's say doubled in the last year and a half. So you're borrowing at a higher interest rate, and even the cap rates are still staying pretty, relatively, they're starting to go up on commercial property, but still relatively low. So you're in this influx situation where your cap rate is higher than your cap rate is, much lower than your interest rate, where it used to be the influx where interest rates was lower and your cap rate was higher. And so these are the reasons why the 1031 exchange is not always your friend. So that being said, we do have the Jake Miller who's coming here. I'm going to ask him to come here in a minute, but in the meantime, Tom, anything else you want to add about the Deferred Sales Trust for the listeners today?
Yeah, I think the other thing is people always want to know, what if I'm transferring, let's say, 5 million into it? Can I take $1 million for purchasing another primary residence for you? And again, it is possible, because then all you have to do is, once you take that amount, you have to pay capital gains tax on that portion. So that is possible, and you can do that. The other aspect of it is, when you do this you're actually deferring the capital gains tax, and the trust life is about 10 years. And you got to remember, during that 10 years, there are a lot of events could happen in your life. So you will have to consider that. Also, at the end of 10 years, you're going to pay, assuming that you're not moving into another trust, you will have to pay the capital gains tax, which is at that time, which is in effect. So these are the two important things to note.
Yeah, and also let you know too, at the end of that 10 years, if things have gone well, the trust can be renewed, or the promissory note can be refinanced, if you will, and the balloon payment can be delayed for another 10 years. And then you can do that every 10 years for 10 years. There's no reason you can't just keep it going, and your kids can step into your shoes and continue the tax deferral as well, which is a powerful way to get this thing going for a very long time. Okay. Now you'll be taking interest payments over those 10 years, and you'll pay an ordinary income tax on that. So, and then to Tom's point, he mentioned, well, you might want to buy a primary home. If you're selling a primary home, That makes sense, right? So actually in Tom's situation, we were looking at that and we said, well, all right, you have X amount. What percentage do you need for a down payment? And then let's, at close of escrow, close of the trust, let's schedule that payment out to you. You'll pay tax on that amount, but let's say 80 or 90% of it can still go into the trust, and that amount will be tax deferred. So it's flexible and it's adjustable. It's not a one size fits all. This is part of where we like to come in and look at the scenario like a Rubik's Cube, right? Everyone's scenario is a little bit different. Some people have estate tax challenges where we're moving funds outside the taxable estate. Some people want to retire and want to have a different location. Some people want to buy a home with part of it. And our goal is to just take this, exit plan and try to coordinate where we're lining up as much as we can congruency for you and what you're trying to solve, right? What you're trying to accomplish. And that deferred sales trust is such a flexible, elegant way to defer the capital gains tax, some income tax, and give you what's called optimal timing and diversification. And so it's the combination of all of these things and knowing how to execute these things and take advantage of them, which makes all the difference, which leads me to bringing in Mr. Jake Miller today. Jake, how are you, sir? Glad you can make it with us today. Where are you at this wonderful morning?
I'm in Copacabana, next to Medellin, here in the country of Colombia. And I apologize. I was on a semi-energetic horse that needed to be calmed down, which basically means I had to ride it around and around and around and around until it could calm down. And so I apologize for coming in short and late, but I want you to know that even with racehorses, you can use a DST. And that just kind of ties right into everything that we're talking about.
That is pretty cool. And by the way, I see you are wearing the Mazlan sweater in the black, and I want to congratulate you for that. And I just see we were meant to be this morning. I got the white on this morning, and so I'm feeling good, Jake. And yeah, to that point, you can defer cap gains tax on cryptocurrency, businesses, real estate, GP, LP interest, carried interest, captive insurance, primary homes. You can save a failing 1031 exchange. Make sure you have your plan lined up and you're working with a QI company like that we're connected with, so you can have that option. And that being said, it does work for racehorses or anything it could work for exotic cars, anything that has really a cap gains tax that we can set up prior to the close of escrow. That being said, Jake, we're working on a few deals that are live right now. Let's kind of transition into that. There's a couple that we're getting squeezed for time. There's a couple questions. So why don't you bring up maybe the 2 or so live deals that we have that were actually really intense this week. Let's kind of unpack what they were, in the general terms, and then what some of the objections were. And then let's see if we can answer those live for everyone here.
Absolutely. So we had 2 doctors who are friends. Both doctors have grown their practice over the years to a certain size. One has a practice worth $4 million. The other has a practice worth 2.7. They've both been negotiated with by a larger conglomerate, and this conglomerate is going to buy out both of them. They both have been networking with and receiving advice from a dear friend of mine who is an accounting firm owner. He provides CFO services. He also provides tax consulting advice. Through this contact, they referred both physicians to us. We've been able to review their scenarios very quickly. The difficult part of their scenario is the timing. A little bit late to the game. I would definitely say that this is the 10th or the 11th hour that we were able to meet and greet, get to know them. And from meeting and greeting, we had to practically skip all of the bases and get married, so to speak, with the strategy, just try and make it work. And that's been, I wouldn't say a challenge so much, because they already had faith and trust in their consultant, who then introduced them to us. And so we relied on that faith and trust, and that faith and trust that was extended to us, we then explained in for thorough detail all of the options to them. Of course, concerned about fees, wanted to make sure that everybody's getting paid appropriately and that there's not any excess or waste anywhere. And thank goodness what we're able to help them do here is save so much money on taxes. I had the numbers wrong, Brett. It's a $5.5 million sale, but it's going to be done in installments. So they're getting most of it now, and then in 2 years, they're going to get the rest of it. And then on the 2.7, they're getting 1.5 now and 1.2 in 2 years. And with that being said, it was a mad dash to try and get everything scheduled because there's a lot of players that have to come together to make this all happen. First and foremost, I met with them and we went high level over everything, qualified them as an eligible candidate. They were interested, and then had a meeting with Brett and the tax attorney. They need to know who Brett is. It's important that there's a third-party trustee, somebody who they haven't used before, somebody that they have not met before, that they're not related to, somebody that they cannot be deemed to have had control and power or influence over, somebody who legitimately is a third-party person. And then, of course, the tax attorney, the brain surgeon behind it all, the person that puts his name and his neck on the line if in case this should ever be audited. So this transaction that could occur, regardless of what's received now and what's received in the future in installments, that transaction could be something that the IRS could look at in the future. Thankfully, this business trust has a lower audit rate than almost anything else out there, which is great. But you never know when they're going to pick your name out of the hat, right, Brett? Or should you be participating in any other businesses and perhaps they audit you because of that other business partner of yours that did that one thing, and then they kind of just wrap everything that you're doing all together in a review, they might pull in the trust, right? And it's good and wise and prudent to have somebody who has a perfect batting record, somebody has a 100% track record or batting 1,000, having your back. And yes, there is the 1.5 on the first million fee, 1.25 on everything after for the tax attorney to provide that lifetime audit protection. And for me, Brett, that's almost like an insurance policy. And sometimes, depending on the risk, insurance policies can be a percentage of the overall dollar size of the event. Sometimes they can be as much as 4%. Sometimes they can be even greater if the risk is big enough. And so whether it's buying an insurance policy or purchasing lifetime audit protection from a real life person who's going to be there, should anything happen to you, Brett, definitely can't speak enough to the point of having that lifetime audit protection, even though chances are, since these business trusts are like the least likely thing to be audited out there, it'll never be needed.
Yep. So let me pull a little bit out of that too. And thank you, Jake. That's amazing, perfect overview. So, first of all, like, what is the tax liability? Like, how are we going to defer? Well, it's typically somewhere between 25 and 50% of the gain. And that includes cap gains tax, federal, state, Obamacare, and probably depreciation recapture. California for sure, right, is high. New York, different states have lower capital gains tax. So you want to check with that state, and we can give you an analysis for that depending on what state you're in. But let's just use the number of 30%. And these are business sales, and these typical business sales have what's called no basis. I mean, most of them we work with, they've been doing it for 20, 30 years. They've completely depreciated everything else. And so like on a $5.5 million sale, for example, if we use 30%, that's a $1.65 million tax liability, right? So you look at that number, and then you'd have to say, okay, well, does that make sense for me to defer this, or should I just pay the tax? Now, I would think it makes sense to just defer it, but it depends if you want to use the money for personal use or not, right? But if you're okay investing it and keeping it growing. So that's the first part of the ROI. The next part of the ROI has to do with, well, how much return can I achieve with this? Well, we're typically returning right around 7 or 8%. It could be 5 or 6, depending on if your risk tolerance, but let's just use 8%, for example, over any 10-year period of time. So on 5.5 million, that'd be 440,000. Now, these particular doctors, for example, you said he's going to take about 4 million up front, and he's going to carry paper for the buyer at 1.5 million, it sounds like. So it'd be on the 4 million would be 8%. That'd be about $320,000 in cash flow, right? And by the way, you might be wondering, well, can they roll in that other installment sale at a later date into the trust? And the answer is yes, they can, right? Which I think led to one of the objections, Jake, which was, well, am I paying the fee on the full 5.5, but I haven't received, I haven't received the cash to it, right? So I feel like it's, perhaps not equitable for me to pay on a full amount. Now, to clarify, for Jake and I, our fee is a recurring fee, somewhere around 1.5% to 2%, depending on the AUM. And that's only paid on the net proceeds, right? So that's after M&A advisors, that's after attorney fees, that's after closing costs or any debt that you have. So in that scenario, for these, and for anyone who's listening, yes, that's how Jake and I work. But the tax attorney is different because their risk has to do with the size of the deal, and their risk has to do with the potential audit and all of the lifetime audit defense that they provide. And so that's how that works. That being said, is there a potential way to do that in installments? Maybe, depending on the complexity of the deal, and the tax team might just decide to elect to do that. But the big thing to say is you can pay a fee of 1.65 million, right? Which is huge, right? That's gone forever. A fee, it's a tax, right? Or you can defer all of that and pay these small amounts. And I think they're relatively small compared to the 30 to 50% that you might pay in the gain. The other point I would also mention, Jake, and let me know what you think about this one, is how much does your M&A advisor cost?
Right.
You know, how much does your real estate broker cost? Right. And is what they're doing, are they the only ones in the country that can do this at the level that the DST tax attorneys have done for 25 years? And so it's really interesting as you look at that. A lot of real estate brokers will charge 5 or 6%. M&A advisors could be 8, 9, 10, 12% on the sale, right? And you're paying these huge percentages, and you have to ask yourself, are these professionals bringing 1.65 million of tax deferral, right? That's just your bottom line number. Are they bringing that? Or could you hire other ones at lower percentages, perhaps, right, to do the same thing that these people are doing? So we challenge and we encourage people to really consider the context of what we're providing. And we really believe that we're like the Navy SEALs of what we do. And there's only one law firm that we've used at all that has had the track record to provide this. And so that would be the encouragement for anyone who's listening about, the fee part of it. So Jake, any feedback on that?
You bring up a lot of valid points, because I've actually, on clients that really trusted me, so to speak, I say that because they've known me for some time, they know how I work, everything else. They've asked me to lay out various strategies that they've been considering. The pros and the cons, the benefits, the tax benefits, the rate of return benefits, and the fees. And to be honest, Brett, out of a lot of the high-level strategies out there, there's this monetized installment sale that always gets audited, right? There's, all of these other things. If you look at just the fees across the board of all these strategies, we're pretty much at the bottom, yet we're providing some of the highest quality talent, so to speak, in the industry. That's something hard to tell a client at the 11th hour and have them believe you. You know what I'm saying? Because it almost sounds too good to be true. But here, for the audience, just so that everybody knows, when Brett and I together charge less than 2%, think of an executor of an estate as an administration fee typically charges one executor between 2 and 4%, depending on what he's managing, how actively he or she is managing, and all of those other things. And this is very similar. It's not the entire estate, it's just the items that have come from a very large sale, right? Which for some people is the bulk majority of their estate. What Brett and I are doing, you're getting 2 people for the price of somebody who's cheap on the price of 1. Yet we're providing literally best support and coverage from what can be found in the nation, according to what we do, in regards to agnostic investment advice. You want to be in marketable securities, be in marketable securities. You want to be in Reg D investments or alternative investments, or you want to be in syndications, you want to be in direct placement programs, you want to just buy somebody else's business or do a startup business. We will show you with agnostic advice as a fiduciary, the best practices of how to do it most effectively based on your scenario. So we bring the tax attorneys in when there's a big one-time transaction, but the ongoing day-to-day is where we help you win, not only in the margins, but we win with all of your future investments to grow them over time.
Beautiful, Jake. Very well said. And now I'm going to open it up for anyone to ask questions for Jake or I or Pierce. It could be your live deal. It could be about the Deferred Sales Trust. It can even just be a comment. It doesn't have to be a question. It could just be, hey, I really like that part of what, Tom Alexander said, or what Jake Miller said, or what Brett or Pierce said. And it could also just be questions. You can either put that in the chat. You can also just unmute yourself and say hello. And we welcome anyone to say or ask any questions right now.
And until somebody asks a question, we can do a survey. What energy drink am I drinking right now?
Wow. Does it have a bunch of sugar, or is it a healthy one?
It has a lot of sugar.
Is it the Monster?
Today, I am sadly not in the Monster. Today, I am going with what's available. And that is the Red Bull.
Oh, gives you wings, my friend. So that is good.
Hey guys.
I have a question. Go ahead.
Yeah, just a quick one. You guys are talking about the fees. Is there an ongoing federal applicable tax on the gains that have been deferred?
Good question. I'll start with that one. So it all depends, Mike. So I think the question is the trust have tax on the ongoing gains inside of that trust? That's maybe the first, maybe that's the second part of the question. Let me answer the first one. Is there an interest charge for the gains that you're deferring? Is that what you're asking, Mike?
By the IRS, yeah.
Yeah. So it depends. How are you? If the person's married or single, okay. Let's imagine you're married. If you're married, you have up to $10 million each year to defer at 0% interest in any given year. So let's imagine you had a $10 million multifamily property sale, and you're going to defer about 10 million of tax, and you're married, and you use what's called the DST 1.0 in a traditional 453 installment sale with the trust. There's zero interest charged on any of the deferral. Okay, any of the deferral, which is pretty sweet. So you can keep this thing going for basically as long as the trust is intact and as long as the promissory note is there. And every 10 years, you can renew for 10 years. So this is where most of our clients will form these trusts as 10-year promissory notes with a percentage of interest to pay out, typically between, let's say, 4 and 6%, even though it's earning 8. So that's of the interest that it's earning. So let's say it's 10 million and it's earning 800,000. You might take $400,000 to $600,000 per year in interest payments and pay ordinary income tax on that. But that other 10 million is that a zero interest loan. It's like a zero interest loan for the government. And that scenario, let's say you had a zero basis, you would have paid 4 million in tax. So on that 4 million, it's zero interest. So the answer is no, there's not. Now, if it were above that number, Mike, and you were to do DST 1.0, then there would be an interest charge. However, we have DST 2.0 for that exact circumstance. That has to do with a very large asset sales, and also has a added benefit of removing the funds from your taxable estate. And there's no interest charge on that. So let's say you had $100 million of Bitcoin you're going to sell tomorrow. Yeah. We could sell it tomorrow, exit your taxable estate, and there's no interest charge on the deferral. However, as you receive payments back, it will be partial cap gains tax, partial interest payment, and based upon your life expectancy. It's not IRC 453. It's a different installment. It's a different form of like an installment sale, okay, but not installment reporting rules. A little bit different. So does that answer the question on that first part?
Yeah, I think it does.
Now the second part I mentioned real quick, you guys may mention, well, what about well, it's in the trust. Like if it's earning interest and those properties or those values are going up and they're selling different stocks at different values, does a trust pay tax? It can, but generally speaking, it does not. And here's why: because it's able to accrue, the interest is accruing as an expense. It's able to report it an expense on its own corporate tax return. So let's give an example. Mike, you sell a $10 million business and you defer 4 million of tax, and that's earning about 8% per year. And that's about $800,000 of accrued interest that's building, as well as $800,000 of interest in the investments. So the promissory note has 800 and the investments have 800. Well, the way that it can be reported on the tax return as an expense to the earned interest, and therefore at the trust level, it's earning zero. You're like, well, what if I don't take any payments? Well, that's okay. It's still able to expense even if it hasn't paid you yet. So it's a very elegant way to defer, but also to wash out tax in any given year. Does that make sense, Mike, on that?
Yeah, it does.
What questions do you have?
So if I were just to add my 2 bits, I think that the biggest advantage for clients that have things going on, the biggest advantage is the power over time. So we've deferred it, right? We haven't made it exempt. We haven't erased it. We haven't done any of that. However, we've deferred it. And now we're able, year by year, to implement other strategies by which possibly you can find some of those exemptions, or possibly, you can find other opportunities to use or reinvest that money and make it better, make it bigger, make it work for you. Time value of money. I just had a consultant that I just met with. He was billing $681,000. He accepted 451 to get paid now. Because for him, in his business, he can reinvest in himself and make with 451,000 today a lot more money than waiting for 12 months to get 681. Now, this is kind of a little bit of a reverse, because now we get to have our cake and eat it too. This consultant gave up a whole bunch in order to have the money now. What we can do with this, rather than other strategies where we don't get full gratification of the money now, we are able to receive the full bulk proceeds, or whatever the sale looks like, into the deferred sales trust today. But rather than having a steep discount to have it now, like paying taxes, we are able to reinvest the net proceeds, net of attorney fees, rather than net of taxes. And now you've got two little managers here. You've got a trustee, you've got a CFO type financial advisor that helps guide you through your investment opportunities as you move forward. You, of course, can be bringing us what you want to do with the trust. We can also be bringing you recommendations, and we coordinate. At the end of the day, you're still the captain of the ship. We're just the workers. We help make it happen.
Gotcha.
Good question, Mike. Anything else come to mind on any of that?
From a generational perspective, like you said, you can renew this. I mean, is it in perpetuity, 10 years, 10 years? It can go to your kids. Can it go to your grandkids? Correct. What are the restrictions before any rules, regs are breached that?
Yeah. What are the generational timing of the trust, and how do you pass it to heirs? What does that look like? Well, there's DST 1.0. And in that scenario, this is typically for 10 million deals and below per married couple per year, but you're not dealing with large estates, right? This is a promissory note, and that is your asset that you can put inside of your living trust. So you have your big living trust, and you have your small promissory note with the trust that the deferred sales trust owes to you. This promissory note can go inside of the living trust, and that can be your kids can step into your shoes. So there's no stepped up basis, but they can step into your shoes and they can continue the tax deferral, and then they can pass it on to their kids as well, and to their kids as well. So that just keeps them in a deferral state, which is, the majority of our deals, is the way that they're structured. Part of that's because it's so flexible for the payments to be turned on and turned off along the way. And so it's really, really, really simple. Okay. The number two way is a DST 2.0, again, typically reserved for very large, either high net worth people above 24 million married, 12 million single, although that's going to cut in half in 2025. You use a DST 2.0 or DST plus, the beneficiaries actually are your kids, or can be your kids. Okay. So if you're a married couple, the beneficiaries of the trust are your kids. Whereas the DST 1.0, there's no beneficiary for your family. It can't be. But the DST 2.0, it can be your kids, and your kids inherited estate tax free. However, it's less flexible in the sense of payment to you. In other words, once the payment starts, it's like a water faucet. It just keeps flowing. And it's part cap gains tax, part interest payments. However, when you pass away and your spouse passes away, now your kids can inherit the trust outside of your taxable estate, which eliminates that 40% death tax, which is huge. So the answer is it all depends. And sometimes, Mike, we use two. We might say, Mike, what's your net worth and what's your goal for the capital? And you say, well, I want some flexible money for the DST 1.0, and I want more estate tax planning for the kids. And we probably would do two, if that makes sense.
Gotcha. Thanks.
It was a great question, by the way.
Jake, anything else to add to that?
Sometimes, again, we talk about the power of timing, but also that this becomes a little bit of a keystone strategy. It doesn't have to be. It just kind of depends on how big of your net worth has been moved into the trust, what kind of assets you have there, what else you're planning on doing, and how many moving parts. We have some people, Brett, that just retire on the money that goes into the deferred sales trust, and they can just be in control of the timing of how it comes out and how it's invested, right? And that's like super simple. Other people, especially very entrepreneurial people, they utilize the deferred sales trust as an ongoing financial tool to help them go buy some real estate. They get into a joint venture and they go do that. They might use their deferred sales trust in conjunction with another business that they have. The other business, which might occasionally sell for capital gains, very large things, and it produces them all the time, and it just continually drops into the deferred sales trust as it goes. And And there's any number of other normal tax saving strategies that sometimes people try to stretch to the limit of what is appropriate and what is prudent with these other strategies, that now they can do them within reason because they have control over timing with the deferred sales trust. They don't have to try to stretch something just because their sales price was a bit larger than the strategy is good for. And so it puts back the thoughtfulness into a lot of the other strategies, into what they were made to do, rather than people trying to make them do more. I don't know if that makes sense to everybody, but it helps when the IRS is not forcing you to make a tax strategy decision because you have a taxable event now, because now you have control over the timing. You can make the best decision in the best way.
Yeah, very well said, Jake. Any other questions for anyone else at this time? And Mike, if you have more too, more the merrier. Anyone can ask him. What's good?
I just had a quick clarifying question.
Go, Pierce.
So for the DST 1.0 and the interest rates, it's 5 million. Is that 5 million net proceeds or $5 million tax deferred?
It's basically
per person.
Like whatever. It's the net proceeds. I guess you would put it, right. So
Okay.
So if 5 million, whatever net is going into the trust, right, and that has to do with the deferral, it'd be 5 there. So it wouldn't be the liability, if you will, right. So
Gotcha.
it's like the total amount that's going into the trust. If it's 5 or 10 million, if it's a married couple and it's 10, we're good. No interest charge. If it's a single person 5, you're good. If it's larger than that, we're either going to do a combo of 1 and 2, or we're just going to do 2 altogether.
Is the interest payments on, let's say it's $1 million liability, tax liability, $5 million net proceeds going in, is the interest rate on the 1 million on the liability,
just on
or
the
is it on the
excess?
total?
Just on the excess. Yeah, let's say you're married and you put 11 million into it. It would just be on that excess, that 1 million. It wouldn't be on the full 11. But
That
again,
excess 1 million,
the excess
gotcha.
of that above that, basically that excluded amount. So if it was 11, on that 1 million to be charged an interest charge, on the other 10 you wouldn't. But again, we wouldn't. I don't think I actually have ever done a deal where it was they did that. They just ended up doing the DST 2.0 because of that.
Yeah,
so,
makes sense.
Yeah. So, but if you still wanted it, sometimes we could stagger the sale. We might do a December 31st. You close out on 10 million, and then January 3rd on the next year you close out on another 10 million, and you could stagger it in 2 different years. So that's kind of a creative way. But that, like, the whole stars have to line up. That's kind of like squeezing it's squeezing it. So.
And then that brings me to second question.
Go ahead.
Real quick, and then we got to get out of here. But if, let's say, someone sells a business and does it in chunks, where they sell, let's say, a portion of it, take portion of it, they don't do a DST, and then in 2 years they're supposed to get another big chunk. Can they do a DST after they've taken constructive receipt of the first amount?
Oh, good question. It all depends. So it depends on how that structure of that sale was set up. And the question is, let's say they did an installment sale. They didn't know about the DST. Let's say it's a $20 million deal. They carried back 15 million of paper, and they didn't set up a DST in the beginning, and they've already taken construction sheet of the 5, and there's 15. They more than likely, we could probably have that note assigned to the trust of that 15. They couldn't get the 5. The 5's gone forever, but it all depends on the actual structure of the deal. We just bring that to us in the tax team, and we would all look at it, me, Jake, and the tax team.
Gotcha.
Good question though, Pierce. That's a good one. All right, everybody. We're so happy that you were able to join us. We want to encourage you to if you haven't already subscribed to the YouTube channel or the podcast, to do that, as well as to share this with someone. It could really help out, and then invite someone next week and come back and hang out with us. Do look for the new book that's coming out. It's called Building a Tax Deferred Exit Strategy. We have the Jake Miller in the book. We have some people also like Kevin here from Shark Tank, and I got a couple chapters as well. But that's called Building a Tax Deferred Exit Strategy. And that being said, Jake, by the way, if you want to find me, go to capitalgainstaxsolutions.com. Pierce, if people want to find you, where can they find you?
Go to kingdomluxuryrealty.com.
Excellent. And Jake Miller, if people want to find you, where can they find you?
strategictaxsolutions.com, as well as 1-800-773-1848.
Or just fly to Columbia and jump on a horse, and Jake might be right next to you. You never know, right? Which could happen.
I actually literally bumped into this consultant here out of the blue. So
tell him you want to defer the tax. Tell him a DST, Jake.
We're talking.
Hey, thanks everybody. So appreciate everyone. Talk to everyone again real soon. Thanks for attending. Talk soon. Bye.